Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope I am audible to you. Let me display the PowerPoint presentation. Tracking the forex market together, part 1 on June 20th between 8 and 8:45 GMT. So before commencing the webinar, I take this opportunity to greet FX Street for the ITC conference, which is just started in Barcelona. I wish them all success in the conduct of the conference. So let me come back to that of the webinar. So it is a simple market tracking technique, and in this we try to use effective trading strategy besides market reading so that we will be able to consistently earn from the market. See, this consistently earning from the market is very, very important for anybody, because we just keep our hard-earned money as the equity and try to use it in order to take positions in the market and try to earn out of such trades. In the process, if we lose our hard-earned money, then it will be painful. So we have to necessarily use the specific trading strategy to limit the risk and maximize the profit, because we all know very well forex trading is risky, but still thousands and thousands of traders world over, they are participating in the trading knowing well the risk, but unfortunately not many learn about the risk management, and as a result you find very frequently the traders lose their account on margin call and try to find out what are the methods by which we will be able to earn back the lost money. So invariably you find that for many traders, trading becomes a costly experience. So instead of that, we have to learn the process of trading or the art of trading, like a driving or swimming, etc. And once you learn the trick of the trade and also the art, then it becomes easy for us to maneuver in the market and try to effectively trade without any fear. And suppose you take somebody to water and ask him to learn swimming, definitely he will hesitate entering into that of the water or jumping into that of the water. It doesn't mean that he is not capable of learning the process of swimming. Initial hesitation will be there, initial fear will be there, but unfortunately in trading, however experienced you were, still the fear continues to grip. There comes the difference between the other skill set like driving, swimming, etc. and that of trading, because in the case of swimming and driving, once you learn how to float yourself, or once you learn how to navigate on the roads and develop the road sense, you are able to drive smoothly. But in the case of forex trading, every time you come across a surprise, so suddenly the market gives a knee-jerk reaction, and as a result you find that traders tend to lose confidence. So how to build the confidence in trading? And for that we need to understand what the players are trying to do in the market and trade along with them. For that we need to read their intentions. So if you want to quickly read their intentions, then you need to use the live market code page as a tool wherein tick by tick the codes are being displayed. Unlike that of the chart, wherein once the candle is closed, you come across such formations. So I'll give the link for that of the live market code page in the window. Okay. Now, once you open the live market code page, you come across the bid and the ask, the high and the low, and also the net change and the GMT time. So currently the GMT time is 8:09 GMT. So we need to track the market using the GMT time frame. For that, we need to understand what are the naturally divided sessions you come across in the market, depending upon the bank opening and the closing in different global positions. So you find the Japanese session gets over by 7 GMT from the start of the day, and between 7 and 7:30 GMT there is a gap time, and 7:30 to 13 GMT is the European session. So we are now about 30 to 40 minutes past the start of the European session. So that we need to understand which session we are trying to trade, and this session gets over by 13 GMT. So normally within the session they try to make the trending move. So we need to understand that they make a small dip during the start of the European session, understand that they wanted to firm up towards close of the European session. If they quickly rise during the start of the European session, understand towards close they are going to make the slide. And if you follow it carefully, it is very simple and easy to read their intentions. First of all, they make a false move, pretend as if they are going to rise and then drop, or pretend as if they are going to drop and then rise the market. So within the session, you come across they maintain the trending move, and between sessions, they make the trend reversal moves. So most of the traders, when they try to take the positions during one session and try to close during the other session, then they become surprised because the players change the trend during the next session depending upon the traders' pending positions, how they are committed the positions. So once the traders committed a totally long position in euro, for example, then they will try to make the slide hit stops and earn their money. Then afterwards they rise euro. So you know very well euro can be dropped and rise based on two factors. It can be the bad news from that of euro, by which euro can drop, or it can be a good news from US, thereby euro can drop. Similarly, it may be a good news in eurozone, thereby euro can rise, or it can be a bad news from US that can also rise euro. So you have to understand which attribute is going to be used during this particular session, and thereby they are trying to gain the levels in the market or drop the levels. So for that we need to understand that three different session times. So Japanese session, European session is from 7:30 to 13 GMT. We are in European session, and the next session is US session. Okay. Okay, I'll just a minute. I'll decrease the volume a little bit. Okay, I think now it should all right. I did that. Okay, so the three sessions we need to follow so that we will be able to really understand what sort of trending move they try to make it in each session. So during the start of the European session, they made the dip in the case of euro and GBP, and they came closer to low but not breached the low set for the initially set for the day around 3:30 GMT. So for that I will just go to that of the next slide and explain to you how we have to note down, use the live market quote page, then go to that of the live market quote page. So once you open the live market quote page, you see the initial low and the high set for the day as the initial low and the high set for the day around 3:30 GMT, and also note down the net change in 4 majors and 2 commodity pairs around 3:30 GMT, and these initial lows and the highs are being referred as the reference levels by the players throughout the day, and then you try to see whether they are breaching the high and taking the market upward, or breaching the low and taking the market on the downside. And once you understand this phenomenon, then you will be able to identify the type of moves. So let me just show you the initial lows and the highs set for the day. So today is Wednesday 20th. So initial low in the case of euro was 1.2662, which was noted around 3:30 GMT, and the high was 2690. And if you see currently in the live market code page, you can see that euro high is 1.2694. They have not breached the low, but they have breached the high. They intend to gain the levels in the case of euro and GBP after the data release around 8:30 GMT. Then GBP, the low is 1.5710, the high is 1.5732, and they breached the high in the case of GBP to 1.5744 during close of the Japanese session, made the dip during the start of the European session, and they intend to gain the levels during the close of the European session. So during such moves, we can do buy and sell trade as we identify they come closer to low, and for 30 minutes from the start of the session, they have not breached the low, so there is a likely chance that they wanted to gain the levels. And the case of yen, it is 78.80 low and 79.12. They have not breached the low or the high. CHF 94.64, they breached it and formed a new low, 94.62. In the live market code page, you can see that, and 94.85 is the high that is not breached. So Canadian dollar 1.0176 and 1.0195 were the initial lows and the highs, and 95 they have breached and formed 1.0197 as the new high. And in the case of Australian dollar, the low is 1.0168, the high is 1.0195. That high they have breached. So here in all the cases, you come across that USD weakening moves. They are trying to do it by breaching the high in the case of euro, breaching the high in the case of GBP, and yen they are not disturbed. And in the case of CHF, they breached the low. So in the case of majors, they breached the lows and the highs and the low in order to make the USD weakening move. But in the case of Canadian dollar, they breached the high. And once they breach the high in the case of Canadian dollar, that means they are trying to make the USD gaining move. If Canadian USD CAD gains level, that means USD gaining move. And in the case of Australian dollar also, they made the upward stop and above that of the high as the USD weakening move. When these two currencies make the contrarian move, understand that before that of the FOMC around 16:15 and 18:15 GMT, their statements, etc., rate decision and statement, they intend to make the contrarian moves. They intend to make the contrarian move in the market, and invariably during such time they will not make any big moves in the market when the traders' participation is very less, because the traders also await the FOMC outcome before making commitments in the market, and as a result, the players also make subdued swings in the market. So you are just seeing how exactly the initial lows and the highs are being made use of, and then subsequently we try to track the market. So net change is the current market level from that of the yesterday US session close or the previous day US session close. So currently you find in the live market code page, let me just focus the camera over that of the live market code page. So you find that euro is currently trading around 1.2677, 1.2679, 2694. They breached the high during late Japanese session and started making a slide, but they have not breached the low. And 8:30 GMT, there is a data release. Probably they will try to make a downward stop and before that, during that time, and then start gaining the levels. That is what they wanted to make today. We are able to see that GBP has come closer to that of the lows, and you find euro, USD yen, and GBP are showing negative net change, which is a contrarian move because euro and GBP are making the USD gaining move, and USD yen is making the USD weakening move. So when they make such moves, the crosses make quick moves in the market. So the crosses are listed in the second table here. You can see the crosses are making more net changes when compared to the majors. Majors are showing about 10 pips. 10 pips, that's a high. Whereas in the case of crosses, you find that 12 pips here and very subdued 21 pips and very subdued moves are seen in most of the currencies because everybody is waiting for FOMC outcome. Let me go back to that of the PowerPoint presentation. So once you note down the initial lows and the highs and try to identify what sort of moves they are trying to do it in the market, and a stop and is the one they try to do it during session start and session close time or early and late sessions, they make the stop and below that of the initial low or above that of the initial high for about 15 to 25 pips and then reverse the market. So if they want to drop the market, they first gain the levels, quickly hit the stops on the upside of the short sellers, then drop the market so that they get the least selling pressure from that of the traders, and then it is easy for them to drop and buy at the lower levels. So they have a mechanism of making a stop and during the start of the session and the close of the sessions, and alternatively if they do the downward stop and during start of the session, then they will try to do the upward stop and during close of the session. You can just watch it how exactly systematically they make such moves in the market. The false move is the one from that of the high, they come up to that of the initial low, then without breaching it, they come up to that of the high very quickly and breach the high and stay above in order to make further rise. So that is referred as a false move. A quick downward move before making a quick upward move. And this false move, they pretend as if they are going to drop as a knee-jerk reaction for a data release, and suddenly they reverse the market and just take it upward so that the traders get the stunning effect, or they are not in a position to decide whether the market is expected to come down or go up. Just to create the surprise, they make such moves because it is a man-made market. They have to make the tricks, otherwise nobody will become afraid of the market. Then there are moves that are more than 30 minutes and up to 2 hours, like the extended move. So they, after a false move coming to that of the low and then go to that of the high and breach the high and stay above, they start gaining the levels for 2 hours from there. And every 30 minutes they breach the new high and take it up. And the last 30 minutes they stop cutting the new high. And then next day you find the reversal and start sliding the market. So the extended move happens during that of the European or the US session times, and mainly such moves are very, very quick moves. So extended moves are very quick move, otherwise normally it is called as the spikes in the market. Then you find either it can be an upward spike or a downward spike, and they reverse the market in the next session or the next day. The intentional move is the one which is a slow move, and they continue to drop for 2 sessions. And the traders lose the patience and cut all the long positions and turn short. On the 3rd session, they reverse the market and take it upward. So this is a patient testing game, and they make such patient testing moves slowly so that the traders lose the patience and cut their positions. And as a smart trader, during such drop, the 3rd session drop, we should be able to buy so that they will quickly gain the level and we will have an assured profit on that. So if you identify the moves correctly in the market reading, then your tradings will go well every day. There is no uncertainty at all. If at all, if you are in a position to identify the type of moves correctly in the market. So this intentional move is beyond 2 hours, up to 2 sessions, and the start of the 3rd session, and then the reversal. Now, this is with regard to market reading. I explained it. Identifying only the type of moves and related to that of the session timings, you will be able to find out what sort of move they intend to make the next, because the moves, they make it in sequence. Then, in order to limit the risk, we need to aim for the trading strategy. And normally the simplest trading strategy is keep stop to keep a stop for any position. If you've got a buy, you keep 20-30 pips or 50 pips below a stop, so that if they make undue drop, you will be stopping out, so you won't incur big loss. And when you keep such stops, you know that the players make very frequently stop and moves. And during the stop and moves, if the stop is filled, you feel very bad and you think that it is better to trade without a stop, so that they will not be able to make the stop end. And that is possible provided you limit your trade to only one position at a given time. And after closing the position, you can just think of another position. But invariably, when the traders take a buy position, if they continue to drop, they add positions as an averaging, and that leads to over trading. And once all the positions make loss, then they are afraid of margin call. To avoid all those things, one can use the hedging. And European, Australian trading platforms and other banks, you have the hedging facility, excepting the US trading platform. And in MetaTrader, it is called as a sell stop or a buy stop. And in some other platform, you call it as entry stop. And if that facility is not available, then you have to use the stop to get rid of the undue risk. And in a loss making position, you have to keep the hedging order. And once the position makes profit, you trail the stop and keep a limit in order to maximize the profit. Because the traders miss great opportunities of maximizing the profit. How? They take the position, they don't keep any stop. When the market drops about 100 pips, when it comes to break even, immediately within 5 pips, 10 pips profit, they simply close the position. Because they had the enormous patience to hold the position when it was making loss. But when it comes to profit-making condition, they become nervous and restless and close it. And later on, when they see that the position is making 100 pips profit, but they are not holding the position, that level is making 100 pips profit, but they don't hold the position to maximize the profit. So, a trading strategy has to be keep the hedging order when the position is making loss 20-30 pips below that of the positions, away from the position. And when the position starts making profit, keep stop at entry and trail the stop, so that the market will protect you a minimal profit. And in case if the going is good, they will try to hit your limit, which is quite high or away from that of the original position, and then you will be able to maximize the profit. So ultimately understand that we are all here to maximize the profit. But in the process of maximizing the profit, when the position is making very good profit, they don't keep any limit. They simply watch. Okay, I will hold it for tomorrow so that I will get much more profit. That's what they think, and don't do any trading strategy or deploy any trading strategy and watch. Suddenly the market reverses the next day and it might be showing loss. So they have to understand market means volatile moves. So if you use the trailing stop, in case if the market reverses, your trailing stop will be hit so that the minimal profit is protected. If the going is good, then you can move the limit away from your position and then maximize the profit. So there are two possible emotional conditions, namely the panicness and the greed. So greediness. So you can easily limit their influence by simply using the trailing stop and the limit with regard to the greed, and using the hedging order in order to limit the panic conditions. So how to decide on the entry? So you have to watch 30 minutes from the start of the session, and if the low is not being breached or the high is not being breached, then near the high we can take a sell position, or near the low we can take the buy position, and try to hold the positions in order to maximize the profit. So as I explained that within the session they make the trending move. So initial move you have to track and then try to do the trades accordingly. You will be able to really make good profit. Now exit. When you are taking the buy position near the low, you have to exit near that of the high. When you are taking the sell position near the high, we have to exit near that of the low. And still we can use the maximizing strategy and maximize the profit either in the sell and buy trade or in the buy and sell trade, identifying the type of moves. Suppose the going is good and you identify it is an intentional move. Wait for the third session start and try to maximize the profit. If you identify it is an extended move, you just wait for 2 hours and then close the positions. So identifying the type of moves and relating to that of the market timings, you will find you don't require any other instruments in order to trade, and there is no uncertainty at all. In case if they hedged the position, many of the people become crazy when the position is hedged and they immediately think their position is hedged, they are struck with that, and many may say that you do not know how to trade if you use the hedging and things like that. And it is something like advising a person having a car without a brake. And if you frequently apply brake, that means you do not know how to drive the car, so better remove the brake. Can anybody say? But in the trading platform, they can simply say, hedging if you use, then you are unfit to trade. No, these are all just diverting statements, or they wanted to make loud noise with regard to hedging so that people will think that if you use hedging, that means we do not know how to trade. It is not at all like that. And if you use the hedging, if the position is hedged, and you can read the intentions of the players very easily by the type of moves they are making. If the hedging is filled in stop and, then it will be making loss for 30 minutes. They simply hedge you and go away and making about 5-10 pips loss beyond 30 minutes. And then you simply close it, understanding during stop and they just filled your hedging. In case if you use the stop, then the stop would have been filled and you won't be having any other position. Whereas if it is hedged, then you can simply close the hedging with stop at entry or with 5-10 pips loss and keep another hedging order to limit the risk. Once they show profit, a buy position, maximize the profit more than that of what you lost in closing the hedging position. Then it is simple. And nobody needs any sophisticated understanding pertaining to this. And if the hedging is making profit for more than 30 minutes, understand that you are struck on the wrong side of the market and keep stop at entry in the hedging, because you thought that it is a stop and during which they were filling the hedge, but the hedging is making profit. That means beyond 30 minutes they are making a drop. Now you have to identify whether it is an extended move for 2 hours or intentional move for 2 sessions and the start of the third session. If it is an intentional move, if you find that it is a slow downward move and they are just cutting their low every 30 minutes, and then wait for the third session start. At that time they will make a quick drop and then reverse the market. During that quick drop, close the hedging position with a profit and keep another hedging order 30 pips below. And when the market starts going up, then you try to close the position with a profit. Otherwise, and after closing the hedging, after the intentional move, take another buy position at the lower level and close the 2 buy positions for the average. Or book profit on the downside in the hedging, book profit on the upside in the original position. So if you try to do the trades that way, whichever way the players make the moves in the market, you are not going to be upright, because we know very well that we are using the hedging to limit the risk. They cannot give me any unlimited loss. So invariably, if they drop, identify the type of moves and close the positions with a profit on either side moves, because market has to necessarily make up and down moves alternatively. They cannot continuously drop or continuously rise the market. Know very well. Now coming to our trading. So it is already 8:30 GMT. Anyhow, in the case of Euro, they are holding it around 1.2677. Let me, so I'll try to keep a buy limit order 10 pips below that of the current level 1.2677. Then my exit initially will be 1.2694, the high, and the entry stop or the sell stop for that will be 30 pips below 1 point. Okay. In the case of GBP, they just made the breach of the low after the data release, and I'm just buying market. $1.5688 because they quickly came down to 1.5659 and then started gaining the levels. See how fast they are gaining it. See, this is how they try to create the fear among that of the traders. If you think that they are going to drop because it is a negative data and things like that, and they are just going to fool you. And because see, you can see the net change, it is only hardly 31 pips negative net change. Australian dollar is in positive net change, and you know that commodity pairs lead the rally, and euro is showing a positive net change of 4 pips, and GBP alone they just made a quick drop to 1.5659 and then gaining it. Because I was talking, so I was not able to pick up when they formed the low, new low, and I just taken a buy and keeping a limit 1.5744. The high set for the day. The going is good. After keeping stop at entry, we can maximize the profit. So initial target exit level will be the high for a buy near that of the low. Then the stop or the entry stop. $1.5658. Then in the case of euro, they are just taken higher, so I don't think they will be able to fill they have come closer to that of the high. So we'll watch for another 10 minutes, and if it comes down little bit, we'll buy. Similarly, in the case of Australian dollar, and it is not closer to low because it is around 8:38 GMT, 1 hour past that of the European session start. So obviously the market has started making the moves, and so I'll just try to keep a buy limit 10 pips below that of the market. $1.0187, and the exit will be 45 pips because it is closer to high. The high is only 1.0196, so exit will be 45 pips. Above market, stop, entry stop or exit. $30 pips below market. So here we take the trading decisions. So by identifying the time frame using the live market quote page and see what sort of moves they are doing it. For the 8:30 GMT data, for the UK data, they just BOA meeting minute, they just made a dip and then started making the gain. So we understand that was a stop and below that of the low. Once it comes above that of the initial low, 1.5710, then they will consistently make the rise in the case of GBP. Then all other currencies are also expected to gain the levels during that particular condition or during that particular process. So here what you have to understand is how we can make our trading decisions very simple. It is not difficult at all. See how they have come quickly above that of 1.27 in the case of euro and above that of 1.57 in the case of GBP. So it is a very simple method of handling the market. So there is no need for us to complicate in understanding the market. And when they are doing it in a very simple process, okay, let the data come. If the data is negative, pretend as if it is going to drop and then rise the market. Then the traders will be questioning why the market is rising when the data is negative. Then they continue to confuse and then they think that it is a false move on the upside. They try to take a sell during the rise. Then the players continue to rise using some other attributes and induce them to do the short covering. So ultimately they create the market sentiment and act against that of the traders. So that we need to understand. It is not that we have to find out what is the support and we will buy. Okay, everybody is willing to buy at the support, but somebody should be able to sell at the support. Only then we can buy. Who is there to sell to us when we keep a buy near that of support? And if we keep a buy near that of the support, if somebody is selling, that means he wants to breach the support and go below. That is why you find that support 1, support 2, strong support and strongest support. That is how we just statistically or theoretically derive all those levels and become afraid and become uncertain at what level to enter into the market. We wanted to aim 30-40 pips in swing trades, but in the process we do so much analysis and miss the main understanding of the market. It is a man-made market. It is the market wherein the men make the moves in the market. So understand their moves. Nothing more than that. Let me minimize the PowerPoint presentation and focus the camera over there at the live market code page and try to answer to the questions which are asked here. And Tetra. Oftentimes when waiting for the 30 to 90 minutes after session start, we miss large moves. There is a strategy to follow the players in their stop and extended moves during those times. That is, enter during gap time. You can also enter during gap time when they make the false move. But today you know that they firmed up a little bit during gap time. We know very well during session start they will make a drop, and that too 8:30 GMT there is going to be data. So invariably during the data time they will try to pretend making a drop. At the time we can enter into the market. So euro came down to 1.2667 and that is how I kept it, but already they have moved up. And in the case of GBP also, our position is making profit. I had taken the buy position at the market. Otherwise we would have caught it closer to that of the low. See, always we have to understand they try to breach the psychological levels and try to set the lows. So 1.5675 is the psychological level and they have gone below that, and in that process some of the stops would have been triggered at 1.5659. That becomes the low. So they don't deliberately set any low with the intentions to say that okay, this pivot point has to be respected or Fibonacci retracement has to be respected, etc. Accidentally some stops get triggered because otherwise some would have just liquidated the long position out of fear. That's said to be the low. Similarly, the high is set when somebody out of emotion buy it, thinking that the market will gain 1000 pips straight away, and he buys and afterwards he sees that the market does not rise. That is how the high is set. So on a daily basis, but we have to find out what is the net change. It is hardly 21 pips net change. So they can gain another 130 pips in the case of euro, or drop 130 pips during the day. And similarly, every currency you can just find out how much potency is there for them to rise or drop by using the net change. Then it is easy for us to understand. No sophistication is required. Then Solomon, tell me who's these people who are moving and manipulating the forex market. See, there are so many people who come to this webinar first time. They ask this particular question: who are the players? So the players are the richest among the people, and their large money resources cannot be accepted by any bank, and they cannot pay any interest for that. They cannot keep such money, billions of dollars, in the bank as fixed deposit and ask the bank to give money. And they will say that you deposit in our investment arm, and that money is being used, put in the investment arm, and then they try to use such money to push the market on the downside or on the upside. That is how they make the moves. Can you use your hand and lift the market up or down? No. In the online trading platform, if you place a high level buy, and it will simply take the position of the market. Or if you keep a lower level sell, and it will not sell there, it will give a higher fill. Whereas in the banks, they can, if euro is around 1.2702, they can keep a buy order 1.2750, and euro can be pushed to 1.2750 in no minute. So for that, they need huge money power to push it, because they also need to pay the margin for such trades. Then Jack, do these session changes in time in years? Yeah, the sessions, I have been using this or noting this session timings from 1998, and they have not changed it, other than that of the daylight saving system and off. Other than that, the timings are all not at all changed. And if you see my earlier webinars, and before the webinars from 2005-6, we had the question and answer sessions in FX Trade, and there you can see I have given the market timings there, and still they are not changed it, because they cannot change it just like that. They need to have a system to function in the market and earn consistently from the market. See how GBP, they quickly gained the levels. Fooled everybody following the data, made a downward stop, and okay, Tetra. On extended move, 2 hours and 2 to 3 sessions, can these moves start during the Japanese session, or do they always start in European and US? Once the volume improves, then they start making such moves. So invariably, it starts from that of the late Japanese session or European and US sessions. Then Jack. Somebody said US session start from 12 GMT. And the SB said start 13 GMT. You said start at 13:30 GMT. Japanese session 00 GMT. Somebody said Japanese session start at 2 GMT. See, we can call the sessions depending upon our convenience. No, depending upon our local time. In your local time also, you can say that session start around my morning or my afternoon, my evening, and things like that. Ultimately, what is more important is how the players are using the session timings. So you watch when the market is making a false move, when the market is making a stop, and then decide when the session start. I do not want to argue with regard to other timings. Then Ray, the session times do not look correct. Okay, fine. These are all the session times followed by that of the players, not followed by that of the traders. Hope you are able to differentiate it. Then Tony, sometimes the high or the low is formed in the few minutes after 3:30 GMT. Can this scenario also happen in the few minutes prior to New York close? After 3:30 GMT, once they set the initial low and the high, they start making the moves in the market, either on the upside or on the downside, breaching the high or breaching the low. They have to commence their trading and the earning process after setting the initial lows and the highs. And with regard to the New York close, see, you are talking about New York close, but US session close is something different. 20:30 GMT now. The last 30 minutes of trade is being taken into consideration, and the average, weighted average of that is used as a closing level. From there, the next day net changes starts. I don't know whether I answered your questions, but that's how we have to view it. Then Mish, I'm in UK and find it more difficult to interpret the market in the US session, as price is usually above or below the initial high low set around 3:30. Do we then use the latest high low? Yeah, you can use the initial lows and the highs, or you can, in case if you are not able to watch the 3:30 GMT market moves, you can note down from that of the chart the initial lows and the highs, what has been formed as the initial low and the high in all the SPO majors and two commodity pairs, and try to relate it to that of the new session. Whether they breached the high and gone above, or breached the low and gone below, you identify. Then from there you can identify whether it was a stop point or an extended move. Because when they are below that of the initial low for more than 30 minutes, that means there is a potential to do the extended downward move. Beyond 2 hours, if they are still below the initial low, understand throughout the session they are going to drop, and the third session also they are going to drop it, and we can do a technical trade, sell below that of the initial low and book profit during the third session drop. And it's a definite trade, you can point out. Nobody can stop you making profit. And Rajesh, little confusion. In late Japanese session, stop and high. So do we should sell? You can do the sell. During the start of European session, price is in the middle. Neither breached high or low. Now did we take decision to buy it? Yeah, session start, Japanese session close, they made that upward move, and we know pretty well they are just expected to make the slide with the help of the market reading as well as the forecast algorithm. So we can take a sell and make a small booking. Otherwise, if you want to be a wise trader, avoid doing sell and buy trade. During such drops, you try to take a buy and book profit during the rise. Because when you try to do the sell and buy trade, and 8:30 GMT, if the data is positive and they quickly gain the level, you will be caught on the wrong side, because the Japanese session, the spread is very, very low. They got a great potential to rise another 100, 150 pips. So avoid sell and buy trade and try to do a buy and sell trade after the drop, buy and maximize the profit during that of the European session. See, that is a wise way of perceiving the market. If you want to grab all the profit, all the swings under their profit in the market, it is next to impossible to human. So the best way is patiently wait for a greater opportunities and grab the profit rather than aiming for 5-10 pips profit. Because euro was around 1.2790, came down to 1.2690, came down to 1.2680. 10 pips would have got it. But if they gain up, you are struck. Please understand which is a wiser way of trading, Rajesh. Then Vincent, are you saying that the best time to order your deal is always 10:30, no matter which type of move the players will make? 10:30, I mean local time, or I don't understand. As far as the GMT time is concerned, around 8 GMT, when the market is closer to low, you can buy and keep the hedging order. You need not worry what data is going to be released. And if you want to be a very, very smart trader, during the data release, when they make an upward or a downward stop and take contrarian position, they drop buy. If they rise sell, they'll be able to quickly book profit. They pretend. No, in the money market, if you want to make money using your own money without converting into effort, the only way to make money is cunningness. Be cunning with others. Only when you are cunning, you can cheat others. If you are a honest man, you will convert money into effort and give that effort to the other man and get more money for that effort and take your capital, and the balance will be the profit. But they do not want to do it that way because it is billions and billions of dollars, and they want that dollars to grow out of greed. So that is why on a daily basis they operate the market, and they don't become tired of earning money. It is not only the money what they want, they have to share it with so many people. And that is why it is something like catching the tail of the tiger. And once you catch hold of the tail of the tiger, you cannot leave the tiger. If you leave, the tiger will just eat you away. So they continue to rotate it. The billionaires, they are in the vicious cycle now. Then Vincent, are you saying that the best times to order? That's I answered it. Yeah, 8:30 GMT. No, best time to order is 8 GMT. Sorry. Would you sell euro now? No, I will not sell because the long-term move is up in the case of euro according to my algorithm. So I will only do buy and sell trade in the case of euro. Buy during drop. I will just buy after the rise. I'll only buy during the drop and keep stop at entry once the position makes profit. Now GBP I have taken a buy position 1.5688 and I'll keep stop at entry and wait for further rise. In the case of GBP, it has come to positive net change from negative net change. Euro also has come to positive net change. And when it sustains in positive net change for more than 30 minutes, I am 100% sure they will continue to rise. So I just read the moves, keep stop at entry in my trade. Not to worry about the trade, I just watch the live market code page, let them take it, and at 13 GMT when they reach the maximum, I simply close the position. Wait for the nation to trade. Simple. Then okay. So in the case of GBP Euro, I will not take a sell because they already breached the initial high 1.2690 and formed a new high during Japanese session 1.2694, and now they have breached the new high on 1.2707. So I will not sell. If I sell, I am going to be caught. I know very well. You can just take a sell and in a demo trade and see what happens to the position. And simply asking, will you sell here? Will you buy here? That means you want to go with my decisions. My humble request to every trader is, you get convinced and you take your decisions and don't follow others' decisions. Then invariably it will lead to disappointments because others have taken the positions with certain other strings attached to that. I will keep the hedging order. Once the position makes profit, I will keep stop at entry. All those things go with that of my buy. But you simply buy and just wait for about 3-4 hours, and afterwards it goes about 30-40 pips. I would have booked profit and you would not have booked profit, and it will come down. You would not have kept stop at entry and the position will make loss, and you will say, you have given a wrong misguidance to me and you asked me to do buy and sell trade in the case of euro which has dropped. That's what you will blame because it is not your decision. So it is easy to blame. If it is your decision, you will blame, and next time you will not commit the same mistake. Okay, NG. Do you think that FOMC meeting will send the minor down as the majority people expect QE3? Let me tell you, sir, they are not going to introduce QE, quantitative easing, and simply it is something like the Greece debacle and the Greece election and things like that. It's yet another story. Simply people are talking about it. and don't go with that. And you know that the players wanted to gain the levels in the market. That's what I can tell you, and not in-depth analysis with regard to QE3, and that is not needed at all for us. And if QE is introduced, then you think that it will give a boost or a bane to that of the market. But let me tell you honestly, it is a manipulated market. This QE is not at all necessary. And simply they give all sorts of attributes. I am not contradicting others, let me tell you very honestly. And you know, it is something like the Greece exit. No, so many developed stories with regard to Greece exit. What happened? So it is yet another story. Don't go with that of the stories, then you lose your focus on the main market. What about the downward stop in euro? It is already done. They wanted to gain the levels. They have just gone above that of the initial high, 1.2694, and staying above there. And they intend to make further rise. USDN is moving in a very narrow range for several days. Do you expect, USDN is making narrow range, and whenever the spread is very, very narrow, avoid taking positions in that. When they make a quick downward stop and you buy, then exit, keep stop at entry, exit when they are making a quick upward move. But soon they intend to make big rise in the case of USD-Yen and Yen crosses. They are doing lower level consolidation with the downward stop and to make a big rise in the case of Yen and Yen crosses. Vincent. But pound did breach the low. Would you sell at 57.32? Won't it be the hedging if you already have a buy position? Why I should hedge here 57.39? I don't understand. I had taken a buy at 1.5688 and currently it is 1.5739 and it's already breached the high 1.5744. Why should I hedge it? I don't understand. If I want, I can simply close it with a profit. I had taken a buy position in GBP USD, and when it goes up, I'll be in profit, and I'll keep stop at entry and maximize the profit. It is only 9 GMT. I'll wait till 13 GMT and close the position. I will show the fate of this particular trade. Euro, they are not filled. Australian dollar, they are not filled my order. So I will not jump into the market after the rise. I just taken the position in GBP. It's enough for me to make profit during European session. And I know very well, every session the players continue to give trading opportunities. As long as the traders are emotional, they will try to play the emotional game. No, just pretend as if they are going to drop and rise it. Pretend as if they are going to rise and drop it. So that pretensions I will read and trade along with that of the players. Simple. Okay. Should we take every new high or low in every session? No need. You just watch till the end of the session what is the high they are forming it. If you want, you can make a note of it in order to fine tune your study. Otherwise, it's very simple. Just always compare it to the low and the high and see where they are taken the market. Fine. No more questions. Let me go back to that of the PowerPoint presentation. So this is the only position 1.5688 and 1.5744 is my this one limit already is filled. So within the session I have booked profit here about 12 pips and 44 pips. So 56 pips profit in that trade. Then we can think of another position later on. So remove all the hedging orders, fine. When this is not filled, this is not filled. So quickly they have shown the profit in the trade. Normally, otherwise I used to wait till the end of the session. Now, I'll come back by 14 GMT and take part 2 of Tracking the Forex Market Together webinar. At that time, I'll explain to you how exactly we have to read all the false moves before the data release. Everybody is anxiously waiting for FOMC release. Okay, and we can just before the release, we can say what sort of moves they are going to do it. I'm going to do it around 14 GMT, and I'll fine tune the level. Fine tune the type of moves they want to make. Just watch during the event, and after the event, you will get surprised the same way they are doing it, because that is the only way they can make money in the market. So once you read their intentions very carefully, you yourself can study and find out, okay, when exactly they are going to make a downward stop and when they are going to make an upward stop, and you can read all those things and trade at ease like a child's play. By 14 GMT. Until then, bye. Thanks for attending this webinar, please.